All right, so we're going to go down the list here. The very first one we come to is our consumer defensive play, which is Coca-Cola bottling, which is no longer an option for us. It is no longer on our list of investable companies. To be honest with you, I'm not sure why. I think it has something to do with the dividend. Either way, we can no longer hold the company, and we do have a sales signal, so let's replace it. Now, what I like to take a quick look at is what is the best company as far as beta. And we're looking at our score here, and it looks like Procter Gamble is number one, with Kellogg coming in at a close second. Target's kind of further down on the list. Let's kind of go through the numbers here and just see how these companies compare. So you know, we're looking at these three right now, right? So let's just highlight here so we know what we're looking at. All right, first things first, dividends are about the same, which is under the sector average. That's, you know, to be expected. Basically, their performance has been fairly good. So when the price goes up, dividend yield comes down. That's the way that works. All right. This kind of lets us see where these companies have come from as far as the stock price goes. We see that Procter Gamble has come up to 92. Kellogg has come down from 72, and Target has come way up from 55. So that's a good look here. The PE, we can't really, you know, Procter Gamble and Kellogg are, you know, close. They're similar anyway as far as businesses go, but Target is not anywhere near what these companies are. So we can't really use the PE to give ourselves a good comparison there. What I do like to look at, however, is the difference in PE, and we see here Kellogg, the price has come way down, and that's the reason why the price to earnings is so much lower. And again, just to, you know, remind myself, Kellogg has come from 72 down to 65. I think it's important to mention here that Kellogg has recently been hit by a salmonella outbreak, and they had to actually recall some of their products, and so that has had an effect on the price, of course. There's also talks of inflation. There's worries about trade tariffs. The dollar has been really strong, which means the dollar has become really expensive. So these American products and these American companies are more expensive overseas. And so Kellogg's a global brand, Procter Gamble's a global brand. Target is the only one on this list that is primarily an American company, and so the dollar going up really doesn't you know, it doesn't affect a whole lot, right? I mean, us Americans, when prices go up, we're kind of just used to it, and we deal with it, right? All right, so net profit, we've already talked about that. Can't really compare. Procter & Gamble and Kellogg, like I said, they're the closest comparison, and Procter & Gamble beats them out. Operating profit looks like Procter & Gamble beats them out again. Return on assets, again, Procter & Gamble. Cash per share, Procter & Gamble has way more cash on hand than these other guys. And I think this is a decent comparison, just because even though Target has a lot of buildings and things of that nature that takes up their cash, they don't typically spend money on a lot of inventory, whereas Procter & Gamble and Kellogg do without the stores. So you know, that's a decent comparison. Procter & Gamble beats those guys out hand over fist. Cash to debt, again, lots of cash on hand, lower debt, which is why we have a higher number there. So that's really good. And it's important to mention here too that this is above the sector average. and the other two are below. So that's really good. Short interest. This is very telling. Procter and Gamble is, there's not a lot of people betting against this company, whereas Kellogg and Target, there's a lot of people betting against them. I can imagine the whole Target thing is probably people assuming that Amazon is going to, beat out Target. There's been a lot of talk anyway over the years. Walmart versus Target, right? And so Walmart has been taking a lot of share. Target has really, I think, found their niche though, with the whole Target thing, right? And they have been competing with Amazon for many years now, and they're holding on. They're doing their thing, and so I can understand though why people are betting against them, and so that gives us a little pause. And just to make note here, this NWL, I don't know a whole lot about this company, but it's really throwing off the averages for the rest of the sector. If I were to take them out of it, the average is still 2%, which again, these guys are way above that, and Procter & Gamble is way below. All right, this is going to be our price difference. Both Target and Procter & Gamble are very close to their 1-year highs. Looks like Kellogg is off those highs. Again, has to do with the fact that they had the salmonella outbreak, and so that affected the stock price quite a bit. There's always talks in the I don't know how to put it, the financial realm, let's say, of companies like this where they're good companies, and they have something like a salmonella outbreak, which temporarily affects the stock price, but eventually it comes back. And so in a lot of cases, these are great companies to buy when they're really cheap, because of those types of events, because they eventually, people forget about it, right? And all of a sudden, Kellogg is back on top. It looks like, as far as, the choices we have here, I mean, I would say they're about the same. Well, again, we got a couple companies down here that's really throwing off the averages. So it's hard to say. If I just took out those two, the sector average is still a -10. So again, they're way above that. All right, 30% off the lows, 61% off the lows. Says a lot, and what that means is simply that this stock price has gone way up and way down over the last year. For it to be 20% under its high but 60% above its low is a big deal. Procter & Gamble is a little bit further up the chart there. See here, and we saw that, right? I mean, Target came from what, $55 all the way up, so it's not a bad deal. All right, Alpha is going to be about the same. Remember, these are not going to be high performers when the market is doing well. They perform better when the market is in a downtrend, and so we expect that number to be low. Up moves. This is the percentage of time that the stock price has increased when there was a lot of activity in the stock, means buying and selling. And so 15% of the time we see that Procter & Gamble has moved up. Roughly the same for Kroger and Target. That price has moved up, about 35% of the time. Down moves 38% of the time, 60 and 50. Those aren't great numbers, but again, these are possibly companies that are, like I said, people are, when they sell them because they have gone up in price and they're selling them to make a profit, right? We've already talked about beta. Looking at the 1-month return, looks like Procter & Gamble beats out the rest. Target, for whatever reason, has not done very well on average, and the volatility is super high compared with its peers. So what that tells me is that even though it has come a long way from $55 all the way up to where it is now, it has fluctuated quite a bit in the interim. And that's important because we don't want anything to fluctuate too wildly. We kind of like that slow and steady increase for investment purposes. And then here we have our management score. I haven't used this a lot. I will fine tune this and then incorporate this into the scoring next year, July 2019. But you know, we can use it here. We have an average of 0.09, and so Procter & Gamble beats that out. This management score, I won't talk about too much, but what it does basically is it calculates all the different numbers that we just kind of went over, such as the cash to debt ratio, the cash to share ratio, return on assets, things of that nature. And so you can imagine, you know, Procter & Gamble beat out pretty much everyone in those regards, and that's the reason why the management score is so high. I have not done the analysis yet to find out whether or not the management score even makes a difference. Okay, so I won't know that until I get in here and actually incorporate this thing. But for now, just kind of a pretty number, right? They beat them out. All right, so let's take a look at Procter & Gamble so far, right? Procter & Gamble so far. No questions asked. Let's take a look at past performance for these guys. And so what we're looking at here is the consumer defensive sector. This is over the last 12 months. You see Philip Morris is our MVP for the sector, followed by Altria. It's important to know that Altria is actually part of Philip Morris. They used to be one whole company, and they split. And so Altria is specifically the American Philip Morris market, and then Philip Morris is the global market. So when you talk about American cigarettes and tobacco and stuff like that, you know, it's very highly regulated. A lot of cities and a lot of places have gone to no indoor smoking, and they've banned smoking around buildings and all this kind of stuff. So they are on two very different planes, you know. I haven't been everywhere around the world, but the few places I have been, smoking is much more tolerated, right? And so I think that was the big reason to separate these companies. So Philip Morris is in a much better regulatory field as far as tobacco and stuff goes, you know, in Europe and other places where they sell their products. Again, it's a global brand. British Tobacco is on the list here, and then we have Target here, and then Kellogg. So looking at the averages, and again, this is for the past 12 months, looks like Target has just blown everyone out of the water, and that has everything to do with the fact that it came, like I said, from 55 up to where it is now. I'm kind of curious. I don't want to go back too far, but I'm kind of curious just to see kind of where we've been. And so we see, just looking here, here we go. All right, Target. There we go, 12%, January 2018. So it hasn't moved around too much. We see this 8% drop here in April. The volatility, I'm going to say, is high, but it's high on the plus side, and so that's a good thing. That's a good thing. So we're going to have to make a decision now. We got Target, Philip Morris, Procter & Gamble. Philip Morris just because it is MVP for the past 12 months, part of that dividend portfolio, I'm sure. Philip Morris. This was all, you know, earlier this year, so it hasn't been on any list recently. So we're not even going to look at that. That's old news, right? So again, we're looking at possibly Procter & Gamble and Target, and it's a hard decision. It's a hard decision. what the performance has been for Target. We know that Christmas is coming up, um, but there's no denying the score and the numbers for Procter and Gamble, right? Procter and Gamble also has a new activist investor, Nelson Peltz. He's also invested in General Electric, and what he typically does is him and his fund, Tree and Fund, they go in, they buy up, 5-10% of these companies, and then they sit on the board, and then they start to make changes, right? It has been seen as a good thing for Procter and Gamble, and so we'll have to see. I'm gonna have to go with Target. We're gonna have to go with Target. Better number. The beta is not horrible, right? The beta is decent. It's in the top 3, right? But the fact that we have this tailwind of great performance recently, we have a previous month that it has, not performed well. We have Christmas coming. We have a great economy, and you pair that with the fact that it has a decent beta. At least, like I said, top 3 for the sector. So we have to go with Target.